Right. We're getting people in. It's exciting. It's Friday. Happy to have everybody joining us as everybody gets in. Chris, why don't you and I kind of take a moment? I'd love, normally we have Rob Chrisman here. For those of you that are joining, Rob is going to be a little bit late today. He's had some flight challenges, as I'm sure everybody on this call can kind of relate to. So instead of me sitting here chatting with Rob about where he is, Chris, where in the world are you? Would you share that with everybody?
Well, I'm not in any exciting place like Rob usually is, Lake Tahoe or anything like that. I'm in my basement of Northern Virginia. I call it my bunker, if you will. So yes, that's where I'm at.
You're in a bunker in Northern Virginia.
Yeah.
All right, I like it.
Now, where are you? That looks like some fancy wallpaper there.
This is not my home. I did not re-wallpaper my office at the house. I'm actually in Louisville right now.
Ah,
And kind of funny thing is we're here for a couple of things. We're here to do some strategic planning for the Mortgage Collaborative, and we also are doing some planning for our March conference. So for those of you that don't know, we are coming to Louisville for our spring, we call it winter conference, but it's March 24th through the 26th, and we're opening up registration soon. So be on the lookout for that. Would love to have you guys join us and spend some time with all sorts of things like bourbon and derby
yeah.
parties.
I
And
was gonna ask you what distillery tour are you taking while you're there, or did you take one today already?
I don't know that I'm gonna steal our thunder on that yet.
All
Well,
right.
we do have some fun plans, and I'll share them as we get a little bit closer.
Cool.
So yeah, the I'm gonna open up the chat, make sure I capture everybody. Um, the Northern Virginia in a bunker, take me home, country road. Samuel Gardner is now officially singing in our chat. Thanks, Samuel.
Not a lot of country roads around here.
No,
Nothing.
Northern Virginia. Yeah, not so much in Northern Virginia. Yeah, I
Yeah,
get
like
it.
big highways.
Yeah, I get that. All right, well, I will go ahead and kick us off. Happy Friday, everybody. I'm Melissa Langdale. I'm the president and COO of the Mortgage Collaborative. This week, we are joined by Chris Perry, the National Credit Union Manager for MGIC. And Chris, just wanted to say a big thank you to MGIC and everything that you guys do for our network at the Mortgage Collaborative. I have my fancy MGIC swag on today in support of you and all of our friends at MGIC. So just wanted to say thanks for joining us and thanks for being a part of our network.
Absolutely. Thank you.
For those of you that did not hear as we were kind of getting started, Rob Chrisman is normally here and he has had some flight delays and challenges today that he's navigating. He is still planning on being here, but maybe late. So we might have a surprise visit from Rob Chrisman a little bit later on today. Until then, Chris and I are going to hold down the fort and do what we can to talk about all things kind of MI, as well as some market news of the week. There's a few things that have happened this week that I think we have to talk about. You
All
okay
right.
with that, Chris?
Absolutely. Let's go.
Fantastic. Well, we'll start with kind of the easy topic, or the easiest topic, I guess, for us is around affordability, right? Obviously, our market has had some challenges right now, and buyers need affordable solutions. You spend a lot of your time in the credit union and community bank space, and so would love to kind of pick your brain around how credit unions and community banks are leveraging MI to kind of meet those affordability challenges in the markets that they serve. Are you seeing anything unique that they're doing that help their customers and their markets?
Sure. Yeah, I will definitely catalog a couple of those, but just kind of quick perspective on that affordable challenge. A couple of facts that are really showing how much that these higher interest rates are undercutting the broader market. The monthly principal and interest payment to purchase a medium priced home right now is 108% higher than it was in 2020.
Wow.
108%. The down payment to buy that home is up 38%. So
Wow.
really staggering numbers. A family earning the medium household income will be shopping for a home that is 75% of the medium priced home in that area. That's down from 143% in 2020. So obviously there's some factors that are really, really, challenging home buyers. And so I would say in the credit union space, as well, probably you could say the community bank and even the independent mortgage banker. The number one challenge of first time home buyers is clearly down payment and payment these days. So utilizing accessing the programs that are available is super important. Knowing all the ins and outs of Home Ready and Home Possible and the refi programs is really, really critical. If you're lucky enough to have a portfolio, such as a financial institution or a credit union, then you get to, move past just those and look at portfolio product. And, we see companies coming up with solutions that look a little bit like a Home Ready or Home Possible or housing finance agency loan, but with higher income caps, maybe some expanded risk parameters to it. Certainly, those who hadn't been focused on housing finance agency loans are and should be, because the way they fund their dollars is kind of left them in a number of circumstances with lower rates than the prevailing rates. So that's another avenue. And then, of course, not a lot of people have access to them, but a lot of talk about special purpose credit programs these days, and how, as a lender, if you're lucky enough to be able to participate with Freddie and Fannie in those, that can give you an advantage in this market.
Yeah. I know a lot of LOs that have been, kind of jealous of those portfolio options that are available within the credit union and community bank space. And so I feel like kind of asking, with everything that's kind of shifted in the marketplace over the last, year, really, are those still being readily offered? Have you seen kind of shifts in changes in availability of those products?
Absolutely. I would kind of describe that the community bank and the credit union space as a tale of have and have nots. And the have nots are growing day by day. And that it really comes down to a liquidity issue. And that could be defined by a lot of ways. It could be simply their credit union's loan to share, or a bank's deposit to asset ratio has just expanded. They've seen a lot of deposit runoff. Sometimes it's a matter of net worth. Sometimes it's a matter of too much retail concentration, and straight off regulators coming out to community banks and credit unions and just saying, keep your powder dry, sit on your money. And so I think where in the beginning of the year, we saw, those institutions coming out with, adjustable rate mortgages, intermediate arms, and pricing them in an extremely aggressive fashion, rarely having much logic to that pricing, just kind of picking a price that's a point or two below the fixed rate. And that was, let them have a lot of success in the purchase market, but it also used up their liquidity very quickly. So those that have put themselves in that position or landed in that position are clearly the have-nots, and the haves are those that still have some portfolio capability. But more, we're seeing them turn that towards niche product than, super aggressive pricing, or at least the pricing is not near as aggressive as it was, back in January and March, which has got to be good news for the independent mortgage bankers that are, don't have that portfolio capability.
Yeah. Well, eh, offering arms is one solution, right? To try to, continue to help with affordability, especially those that are priced, kind of below market. There's also other kind of, MI solutions that people can leverage, like your Choice Monthly, plan and those sort of things. Are you seeing the percentage of lenders and, excuse me, particularly credit unions and community banks, the percentage of either single premium or single premium financed or lender paid or Choice Monthly, these kind of, non-monthly, borrower paid MI solutions increasing as the year has gone on, or is it just kind of continuing to be mostly kind of monthly MI that you're seeing come in?
That's a good question. Certainly, lender paid is still a very small amount of the industry's volume because of the additional capital requirements that the FHFA require. Single premium is not really increased that much dramatically. The agency's execution on that with the agencies is generally at 90%. But the pricing has come way down on those programs. Some of the credit unions are taking advantage of their capabilities of allowing to finance a single premium above 95 or 97. And some of them have embraced the, we call it Choice MI, but it's basically a custom split. But it's still, all those programs are still a very small percentage of our overall product mix. It's generally the good old fashioned monthly programs that people are going with, and in part because of risk-based pricing. When you've got a high credit score and a good DTI, you're seeing the lowest mortgage insurance that's been around in my 30-year career in it. And we're also running at, I think because of the purchase element of the industry having, so much of it being purchase business, we're running at about 18 or 19% mortgage insurance, which is the highest it's ever been in anyone working at MGIC's memory.
Oh, that's great. And by the way, guys, I rarely mention this, but if y'all have questions, please don't hesitate to put them in the chat. Steve, I did see your question. Rob's delays related to the airport are not related to security dogs. So just to stop the rumors or funny comments, no.
They might be related to the bar at the airport, but probably not the security dogs.
No, we there's been a lot of airport challenges. I've personally experienced them too. So,
Yeah.
you talked a little bit about kind of portfolio products. You talked about kind of, credit unions and in some cases, community banks being able to offer these kind of high LTV options. As we look at, luckily kind of job market is continuing to remain strong, even with all of the, kind of challenges and interest rates and those sort of things. But I'm just curious, as we go down, as we continue down this road, if you are kind of projecting or thinking that kind of delinquency rates within those kind of higher LTV products are going to be affected, particularly in the portfolio space, but just would love your thoughts around it.
From the perspective of MGIC, and we stated on our quarterly call 2 days ago, we see, credit quality really holding up strongly. There may be some smaller challenges in a couple of the, areas in our country where we've seen some home depreciation. But, with a large amount of equity and the tight underwriting standards, the performance has really held up, and we're not expecting that to degrade in any way, really.
Great. Yeah. I mean, I think I would feel differently about it if our job market was different. But that's holding so strong that I agree with you. I don't see any changes coming in the future, but thanks for sharing.
Sure. An aspect of kind of the credit union world that I could share, and I'm sure many of you independent mortgage bankers experienced this in the last few years. TPO, third party lending, had really become a thing, if you will, in the credit union world, and was really expanding about a year ago before this liquidity crunch hit. And I think it probably first happened with one of the very large, well-known credit unions that had a nationwide TPO offering for 80 and below jumbo. I'm sure everybody knows who I'm talking about, but they hit a liquidity issue and they kind of froze their TPO. But there's still a number of credit unions that are involved in that. They've kind of raised their prices a little bit, maybe gone more towards niche product. And there's still some that are planning on entering into that world. So, I would say that a trend that we've seen over the last couple of years is independent bankers really, marketing to trying to form relationships with credit unions. And I would continue to do that. You just might take a different slant instead of asking them to, offer you a 5.5 arm at 5.25, because any amount of liquidity will be filled up very rapidly. Kind of go on the, the niche product. Sell them, non-mortgable condos or second homes without the high, loan level price adjustments, or a 95 jumbo, or a community affordable type product that's got maybe not so restrictive income amounts, things like that.
Yeah. Well, Chris, we've got a couple of questions in the chat that I want to make sure we address. Terry asked, are there loan amount ranges which are more stagnant than others? And then Samuel actually kind of pulls on that a little bit more and just says, are there any attributes or characteristics like delinquency rates that seem to follow those loan numbers?
We do not see a different performance in higher loan amounts. And that's, you could see that through, with risk-based pricing, it's hard to kind of see that, but we have not had a jumbo adder for a number of years. So yeah, even with the robust increases in loan amounts, we don't see that as creating a higher risk.
That's great. Awesome. Well, thank you, Terry and Samuel, for your questions. All right, so we had a couple really big things happen this week. One of which, obviously, the Fed came out and said that they're, not going to raise rates for now. There's a lot of things that kind of pull into that. Obviously, like we talked about, our kind of job market is still holding strong, but there is kind of. They're saying that kind of tighter credit conditions with higher interest rates and tighter financial conditions because of the steepening yield curve are causing them to not have an increase at this point. But I'm just curious. We're hoping that means also that this might be the end eventually of their rate hike cycle. But what does this mean for your credit union friends?
That's a great question, because there's a kind of a phenomenon that is brewing, if you will, as a financial institution, either a community bank or a regional bank or a credit union. And I call it the 3 to 5 phenomenon. So yes, they've experienced losses of deposit, which has reduced their loan to deposit ratio or loan to share ratio. But they're in this unique predicament of they have large portfolios of 3% loans and they're paying 5% on their deposits, which obviously is not something that they can continue doing. And probably the only way out of that is to lend at these higher interest rates, considering trying to move a 3% first 30-year fixed rate mortgage is going to cost you quite a bit of money. So I think there's a great feeling that those that need to do that are kind of holding on until the Fed really declares, a flag in the ground. And we'll certainly see, if this occurs, but I know a number of people that feel that when that occurs, it will loosen up some of the portfolio money that's been on the sideline to try and solve that issue of, the disparity between their average interest rate on their portfolio and the deposits that they're paying.
You think that'll open up secondary channels like TPO back again for some?
Yeah, quite possibly.
Yeah.
So I encourage people, if you've been dialoguing with credit unions, continue to do so, because that could very well occur.
Yeah, that's great. So the other big news of the week, Tuesday, right? The National Association of Realtors, kind of suit. Obviously, there was a jury that ordered NAR and a few big real estate brokerages to pay almost $1.8 billion in damages. They're kind of stating that there's an artificial kind of inflation of commissions to agents. But this has really been going on since 2019, right? This isn't like, something that just happened. This has been kind of a journey over quite some time, and has also, already started the appeal process as well. But the implications of this are huge for a lot of the markets that we serve. And, there's particularly a push for kind of one of the implications of this could be a push for buyers to have to pay for their own buyer's agent commission. And in, a time where affordability is already a challenge, what does this do for those kind of first-time home buyers that are already struggling with kind of down payment options and those sort of things? Like, how do you see this kind of playing out over the next, assuming, this change happens tomorrow? Like, what kind of effect would that have to buyers today?
Well, it's I kind of come at this from a couple different angles. One, in talking with a couple of large lenders that are aligned with realtor operations, they felt that it actually, that there'll be settlements, but things won't really significantly change from the way they're doing business now. And I tie that with my own personal experience, where my wife and I are planning on selling our lovely home here in Fairfax, Virginia, and moving to our beach property in Delaware. So I am faced very much with this decision of, I found a great listing agent, and they are strongly recommending, the idea is to price it a little bit under the market, get a tremendous amount of traffic, get a bidding war going, sell your home in a weekend. And to do that, they're telling me, well, you gotta pay a decent amount, offer a decent amount to the buyer brokers. So I'm looking at that thinking, well, that just sounds like business as usual. And so from a personal standpoint, it's really hitting home. Then I just get confused by it, because it to me, the insurgence of buyer brokers in the market was a really important thing to happen in terms of having somebody represent those, especially those first-time home buyers, where they, previously were basically working with two agents that were both working in the seller's best interest. So to me, it's kind of a head scratcher to try and disturb that system that's working pretty well. But
yeah, gosh, it's such an interesting thing to me. I agree with you. I think, particularly for some home buyers, but frankly, everybody needs the expertise that a buyer's agent brings to the table. And, there's everything from, kind of buyer's agents don't just go show you the home, right? They're not just letting you in. It's not like they're, giving you the keys and letting you explore, right? They're telling you about the market and the area and the neighborhood. They're giving you analysis to understand if the price point is a reasonable price point. It's all of those things that their expertise is so valuable in, that I just, I would hate for this to impact a buyer's ability to really truly understand the market that they're buying in, and for them to make a decision based on information that they just don't have because they're not properly represented, because they can't afford.
Yeah, I can't agree more. I wouldn't sell or buy a home we did lots of research, and and I'm very confident that we've got an extremely successful seller's agent, and I'd be doing the same if I was buying. Even at my later stage in life where I've transacted on a number of homes. Yeah, so, and also like you mentioned earlier, the affordability. If buyers now have to pay their buyer broker, that's just going to make the whole situation even worse with affordability.
Yeah. Well, obviously, in case anybody's looking for a bunker in North Virginia, you can reach out to Chris. I don't know, but I wanted to make sure we touched on. Sylvia actually put a comment in the chat for us. You know, she's, I guess, got some concerns around who's paying the commission. There is this kind of strange dynamic, obviously, with it coming from the seller and it feeling like there's kind of an enticement to, you know, to transact with them. You know, I don't know that there's any great solution for that. It's an understandable question that Sylvia's got, and she says she's just playing devil's advocate. But I'm curious what you're hearing from others, you know, as you go out and kind of talk to your credit union friends. What are they concerned with? What are they kind of sharing is, you know, that they're hearing from their agents and how they're navigating this?
You know, I have not really, I've talked with some about it, but in large part, they're kind of taking the same view that it's, you know, interesting where it's evolving to, but how much it's going to actually affect the market and change the market. I think there's just a big question to that, because, you know, what buyers can afford to make, you know, to pay a 2.5 or a 3% commission in buying a home. And you know, are they going to be attracted to those, you know, transactions that are forcing them to do that? No, they're gonna be more attracted to, you know, situations where they don't have to do that. And as a seller, I certainly don't want to, you know, take a good portion of the possible buyers out of the picture by not offering, you know, that commission.
Yeah. All right, I'll ask kind of a wonky question, but I've heard rumblings, small rumblings of lenders starting to look at kind of creative solutions. If this shifted, if this was like the first part of, you know, a shift in how commissions are done in general, whether that be kind of listing agent or buyer's agent, how all of that works. If it really shifts to the buyer's responsibilities, you know, there's quiet rumblings of, well, could I create a loan product, you know, for example, that could help those buyers that couldn't necessarily afford it to finance in that commission. Are you hearing anything like that from a portfolio perspective from your credit unions, or were you just, this is going to be a long journey? You know, for us, obviously, it took us, you know, almost 4 years to get to this point. So, you know, we're not going to probably see a shift to market in the next, you know, 6 months in this. But I'm just curious if anybody's, you know, starting to kind of rumble, gosh, if I have to get creative, I could do this.
Yeah.
Are you hearing anything like that?
I've heard a little bit of that, but I can tell you from, you know, my own experience, I spent years kind of pitching to portfolio lenders. Well, why don't you allow, you know, a financed MI premium above 97? It equates to a very low principal and interest payment. It's a non-agency product. You can't really do that. You know, it really helps with affordability, and very few of them ever went through the process of setting that up. So, you know, it's great to have the portfolio capability, but you got to really, you know, embrace doing the work, creating those programs. So I've heard of it, but I would be surprised if it was any large movement towards that. And as you said, it may take a couple of years to adjust to this, if at all.
Yeah. Amy actually has a fantastic comment in the chat that I want to make sure that we talk about too. She says, you know, that the whole kind of argument really is that home prices have also included this, not only the listing agent costs, but the buyer's agent costs. And so we have this kind of artificial inflation of home prices as a result of that. And so she's, you know, saying, is it possible for home prices to, you know, if would the sellers be willing to kind of accept a lower price because they no longer have to pay out this buyer's commission and like, you know, if you heard anybody talking about what would that do to our market, what would that, you know, we've traditionally seen these appreciation rates in housing, and housing has traditionally been incredibly strong as a result. You know, are you hearing anything or have any predictions that you feel like sharing with us about kind of what that would do to the market?
Yeah, you know, it is interesting. As I said, like I can look at through this lens of being a home seller right now. And honestly, I think when you go to sell or buy your home, you know, you're depending upon your agent to help you in that negotiation. And it's such a complex thing, right? What is the exact value of a home? Well, it has to do with how many people want to buy it, how few or many properties are there like it, and the comps and all. So I can't imagine that, you know, you're still going to have an agent that represents the buyer and an agent that represents the seller, and they're going to get paid in the transaction one way or the other. I still keep on landing at, if you're trying to push that buyer broker commission to the home buyer, that it's going to just really hurt affordability more. And it is an interesting argument to say that, well, you kind of, you know, as a buyer, you don't have to pay that, but then as a seller, you do pay it. So, you know, you kind of end up paying it just down the road when you sell the home.
Yeah. Yeah. I almost wonder, you know, back in the day when it was really much more of a buyer's market, the sellers would offer, you know, to pay all these closing costs. So I almost wonder if we're going to see a shift of this coming from the listing agent and sellers just going, okay, well, we'll pay for buyers, you know, commissions of X amount as a result. And if this really won't shift at all, but we'll see.
Yeah.
You know, lots to still unfold, obviously, as we learn more about what's happening. There's one question in here, and our chat has like a billion things going on, so hold on for me. How many buyers were buying homes without even seeing the property or getting an inspection in the not too distant past? Do you have any insights into that at all?
I don't. I mean, we've all heard anecdotally, and I think there are some that occur, but percentage wise, I've never heard that was a very large percentage. Yeah. But you know, when you've got inventory so tight, and if you need a home in a particular market, and there's one home for sale, you know, you might be in a position to need to do that, right?
Yeah,
So,
I think, John, it is a fantastic question to ask, because the market really has. I mean, to Chris's point, we have, you know, obviously come out of this incredibly competitive market where people had multiple offers going in on houses, and the inventory was so low that if you really were in a position where you had to move, you're relocating for a new job or whatever the case may be, you were more likely to step in and say, okay, well, I don't really care about this being broken. I'll fix it down the road. Or, you know, I don't really care about an inspection because it's not gonna make any difference. The seller's not gonna fix anything anyways.
yeah.
And so, yes, that's a fantastic point, John.
And then I saw someone, I think it was John also, that made the point of, why does it have to be 3%? And I agree with that, actually. I'm, you know, again, considering, I'm thinking, well, 2.5 might work, right? I like 2.5 better than 3. So
yeah, well, especially because you're in the point where you're looking to sell your house right now.
Exactly. So even 2% even looks pretty good. But then you kind of, I think as I've talked with the listing agent, you run the risk of, you know, well, the really best buyer brokers might not show your home. But again, the inventory is so incredibly tight that, you know, if you need to show a home in that price range, in that genre that your buyer wants, you don't have a whole lot of selection.
Well, I also think though, in the information age of Zillow being on almost everybody's phones right now, because you want to check out your neighborhood and, all of those sort of things, the likelihood that an agent's not going to show a home because it's, 2.4% instead of their kind of standard 2.6. That's just a random example, guys.
Yeah.
But the likelihood that they're going to tell their buyer, oh no, I'm not going to show you that house, because the buyer's requesting them, right? In most cases, they're actually sending them the list of these are the ones that I want to go see. And so, I wonder if there is a shift in that, but again, we'll have to see. We have to, a long journey ahead of us with this lawsuit, and we'll just, have to keep our eyes on it and pulse on what's happening. We are up at time, and we did not get a chance to see Rob Chrisman today, but we're hoping he has safe travels and all of that. Thank you guys so much for your comments, your interaction with us. All of that was fantastic. Gave us some really great things to discuss. Chris, thank you so much for your time and for joining me today. For those of you that joined us, if you found this stuff valuable, please like or subscribe to us on YouTube and our TMC Connect channel. Would love to connect with you there. And happy Friday, everybody. And we will see you next week.
Have a great weekend, everyone. Thanks so much.
Absolutely.